While everyone was busy talking about AI breakthroughs, stock market milestones, and the next trillion-dollar tech darling, silver quietly staged one of the most dramatic moves I've seen in years. Silver didn't just rise, it erupted. From $30 at the start of 2025 to over $60 per ounce today, a 100% jump. In just a few months, and here's the part that made me stop, lean back in my chair, and say, okay, something big is happening. Silver now represents 6% of the total value of the world's largest assets, pushing itself up the rankings and, believe it or not, closing in on Microsoft's position. Yes, that Microsoft. So, the question I've been asking myself, and now I'm asking you, is this: why is one of the oldest forms of money suddenly waking up in a world obsessed with the newest? Why now? Why this moment? Because under the surface, the global monetary system is shifting, and silver is simply the first warning light to flash. If you're new here, make sure to subscribe. One click keeps you informed and never left behind. I'm Albert, and let's dig deeper. After seeing the silver double, I didn't just look at the price and celebrate. I asked a more important question. Okay, but where are we in the bigger cycle? So I pulled up one of my favorite lenses. Not gold versus the dollar, not silver versus the dollar, but gold and silver versus the S&P 500. Why? Because the dollar itself is constantly being devalued. Measuring assets in dollars can hide what's really happening. But when you measure one asset against another, like metals versus stocks, you see who's really gaining power. Here's what the numbers say. Back in 2011, at the last major precious metals peak, it took about 36 ounces of silver to buy the S&P 500 index. Today, it takes around 118 ounces. That's more than 3 times as much silver for the same stock index. In other words, the S&P 500 is 227% more expensive in silver terms. Now let's look at gold. In 2011, it took roughly 0.8 ounces of gold to match the S&P 500. Today, it takes about 1.6 ounces. So the S&P 500 is now 101% more expensive in gold terms. What does that really mean, in simple terms? It means that even though gold has roughly doubled since early 2024, and silver has doubled since the start of 2025, stocks have outrun metals over the last decade plus. So no matter how high gold and silver may look on a price chart, when you compare them to the stock market, they're still relatively cheap. This is not the profile of a late-stage bubble. This is the profile of an asset class that's just begun to wake up. To understand how far this can go, we need one more piece of the puzzle. The indicator I rely on most when it comes to timing metals cycles: the gold-silver ratio. Now, if you've been with me for a while, you know there's one indicator I always come back to when I'm trying to understand where we are in the precious metals cycle. It's not the price. It's not trading volume. It's the gold-silver ratio, or GSR. The GSR tells us one simple thing: how many ounces of silver it takes to buy 1 ounce of gold. And for decades, this ratio has acted like a compass. Let me show you what I mean. Historically, gold and silver tend to peak when the gold-silver ratio doesn't just drift lower, but drops sharply, almost like the floor giving way. Here's what that looked like in past bull markets. In the late 1970 seconds, right before the explosive peak of 1980, the GSR fell by about 60%. From 2008 to 2011, the run that pushed silver to $49, the ratio dropped 61%. These weren't random events. They were the same pattern repeating. When the GSR plunges, the metals market is usually entering its final, euphoric phase. So, where are we right now? In 2020, the GSR reached an extreme 113, the highest level in modern history. Today, it sits around 72. That's a decline of only 36% from the top. In other words, we're barely halfway to the kind of drop that historically marks a true market peak. And if the past is any guide, a realistic target for a local or intermediate top in this cycle would be around 45 on the ratio, not 72. Which means we are nowhere near the end of this cycle. If this bull market were a climb up a mountain, we haven't reached the summit. We haven't reached the ridge. We're still hiking the lower trails, while most investors haven't even left the parking lot. But to really understand what could happen next, and how high gold and silver might go, we need to look back at the last two major cycles. Because history leaves a trail. If you know where to look, let's move to that trail. Now that we know where we stand in the gold-silver ratio, the next question is simple. What happens next? How high could gold and silver realistically go if this cycle follows history? To answer that, I went back to the two most important bull markets in modern history, 1980 and 2011. But instead of looking at their final peaks, I looked at the moments when those markets were positioned exactly like today. When the GSR had fallen about 36% from its high, the same drop we've seen in this current cycle. And here's what the data shows. Broken down simply. Let's start with 1980, the explosive cycle. At this same stage in 1979, gold still had 150% more upside before hitting its peak. Silver still had 295% more upside. In plain English, the biggest part of the move hadn't even begun yet. The 2011 conservative scenario. At the comparable moment in 2010, gold still climbed another 32%. Silver rose another 71%. Even the quieter cycle still had meaningful room to run. Now, let's apply those percentages to today's prices. If today behaves like 2011, gold would rise to around $5,500 per ounce. Silver would rise to around $100 per ounce. If today behaves like 1980, gold could push above $10,000 per ounce. Silver could surge past $200 per ounce. And here's the key point I want you to remember. In other words, based on history, we're not looking at a market that's topped out. We're looking at a market that's only halfway through the script. Now the next question becomes, why does this cycle have the potential to run even longer and stronger than the past ones? For that, we need to talk about where the big money is and where it isn't yet. Let's dive into that next. If there's one group I always pay close attention to, it's the central banks. For nearly 2 decades, central banks around the world were selling gold. Then, almost overnight, something changed. In 2010, they reversed course not gradually, not cautiously, but decisively. They began buying gold again, and they've kept buying for the past 15 years. And here's the important part. They're not buying to speculate. They're buying because they see what's happening to the global monetary system long before most investors do. They see government debt exploding. They see inflation simmering under the surface. They see the US dollar slowly losing its ability to dominate without question. But what's even more striking is this. Central banks still haven't bought enough. Many of them are only just beginning to rebuild their reserves. Some have barely dipped their toes in. Most are still on the sidelines watching, waiting until the decline in confidence toward US treasuries forces their hand. And while central banks are positioning quietly, the behavior of large investors and institutions is even more revealing. ETF allocations into gold, one of the best ways to measure overall sentiment, are currently only a quarter of what they were during the 2009-2011 bull run. In other words, most big money players simply aren't here yet. They still believe in tech stocks. They still believe in the growth narrative. They still believe the financial system can keep outrunning its own problems. Meanwhile, something interesting has happened. Gold allocations have only just matched crypto allocations right as crypto flows begin to weaken. The smart money, the quiet money, is moving back towards stability. And retail investors? Most still dismiss gold as defensive and silver as irrelevant. They chase stocks, real estate, and whatever asset is hottest that month. All of this tells me one thing. The gold and silver story isn't crowded. It's not overplayed. It hasn't even started to fill up yet. And nowhere is that more obvious than in the silver market, a market now on the edge of breaking free from decades of paper suppression. That's where we're heading next. If gold is the asset that central banks quietly accumulate, then silver is the asset the market has quietly underestimated for decades. For years, most traders treated silver like a paper market, something you could suppress, hedge, or push around through futures contracts. But that game is getting harder and riskier, because silver is no longer just a precious metal. It has now been officially classified as a critical mineral essential for energy systems, solar production, electronics, military applications, and the broader transition into a high-tech economy. Which means demand for physical silver is rising faster than paper markets can pretend to supply. And that tension is beginning to show. Over the past year, we've seen a surge in futures contracts requesting actual physical delivery, not cash settlement. This is the part that matters. When paper promises collide with real-world scarcity, the paper market loses. And it's already wobbling. Just a few weeks ago, the Chicago Mercantile Exchange, the heart of the silver futures market, experienced a temporary trading halt. To most people, it looked like a technical glitch. But if you've watched markets long enough, you know this pattern. When a system is strained, the first thing to break is always the technology. The incentives to suppress silver are disappearing, while the incentives to go long, aggressively long, are growing. The tighter the physical market becomes, the more dangerous it is to bet against silver. And when those long-term suppressors finally flip their positions, the move can be explosive, the kind of candle that rewrites the chart in 1 week. Which brings us to the bigger question. If silver is breaking free, and gold is quietly revaluing, how far can this cycle actually go? To answer that, we need to look at the long arc the force is building toward 2033. Let's go there next. Now that we understand what's happening beneath the surface, let's zoom out far beyond this year, far beyond the next price target, and look at the bigger arc forming on the horizon. Because this bull market in gold and silver isn't just about scarcity, or central banks, or supply and demand. It's about a global monetary realignment that's been building for more than a decade and is likely to accelerate straight into the early 2030s. Here's why. Around the world, central banks are quietly shifting their reserves away from U.S. treasuries and toward gold. Not because they want to, but because they have to. U.S. debt is rising at a pace that even Washington can no longer explain away. And the value of Treasury reserves, the backbone of many countries' financial security, is eroding. Then, we have the year 2033. According to the U.S. Congressional Budget Office, that's when the Social Security Trust Fund is projected to run out of money. When that happens, the government will have two choices: cut benefits, which is politically impossible, or print money on a scale we've never seen before. And if history has taught us anything, it's this. When a nation prints, gold and silver don't just rise, they reprice. But here's what I want to know from you. Do you believe the dollar can survive the next decade without major consequences? Or are we heading toward a reset of value itself? Let me know in the comments. I read everyone. And just a quick disclaimer, nothing in this video is financial advice. My goal is to help you see the bigger picture so you can make informed decisions for yourself. If you're finding this breakdown helpful, make sure to subscribe. One click keeps you informed and never left behind. I'm Albert. See you in the next video.